Welcome to the Real Estate Corner. I'm Angel Muscatelli of Angels Realty, and with me today is Bob Preveledge of Zenith Mortgage Advisors. Bob, welcome.
Thanks for having me.
You're welcome. Today we're going to be talking about the first-time homebuyer credit and also the other credit for current homeowners. The federal government is offering credits to people that are purchasing homes in today's market. So what I'd like to do is start off with the home buying process. So Bob is joining me today to discuss that. So if you're considering this, it might be something you want to write down and to make yourself feel more comfortable, because I feel education is very powerful. So Bob, if someone was considering purchasing a home in today's market, what would be their first step or their first direction to do?
The first thing today is probably to obviously get in touch with a great realtor. And secondly, and at the same time, frankly, get in touch with a lender or a mortgage broker. The reason being, you want to check your credit score, see how that really looks. What I find a lot of times, and consumers don't realize this, is the credit reports that I get look very different from the ones you can get on freecreditreport.com or whatever those consumer websites are. The scores are different, the history is often different, and the ones that I use are accurate and meaningful, and the ones that you can get consumers aren't always as accurate.
Oh.
So it's a big difference, and it needs to be a real credit report so we know what's actually reported there that will have a dramatic impact on the amount of down payment required, the rates you're offered, the terms, things, and whether or not you can get credit at all extended.
Well, that's interesting, because those commercials are very popular.
Very popular. It's a huge industry right now, and unfortunately, they don't report the scores the same as the trade scores that we get.
Now, when you're talking about a credit score, what is there an average credit score? Is there a credit score that someone needs in order to be able to purchase?
The minimum credit score for most investors right now, the minimum credit score would be a 620.
Okay.
Between 620 and about 700 there's a big disparity in the rates you'll be offered. If you have a 620, you're very limited to the types of programs and the rates. Once you get over 700 or 720, the opportunities get much, much more varied and better. So if someone has a 660 credit score or 640 credit score, which in years past was not terrible, now that's a pretty fair at best score and will have a significant impact on the process.
Is that because of all the new regulations with the banks?
It's the tightening, exactly. It's the tightening of the credit standards because of what happened over the past 2 years. Wall Street has now reevaluated the risk associated. And so they really put a very, very heavy weight on the credit worthiness determined by the credit score.
Is it correct to say if your credit score is higher, you could have a lower interest rate? Or?
Absolutely.
Okay.
Absolutely. When you look in the paper these days, early 2010, you see rates quoted in the mid-4s to 5% range. That is assuming great credit and down payment.
So it's not for everybody?
It's not for everyone, unfortunately. Okay. And if your score were, instead of being 740, were 700, you'd find that may translate to a quarter point in the rate, which is 700 is still very good credit, but it's a big difference. And now you go from 5% to being at 5.25, and that changes the payments by $50 to $100 a month, and affordability changes as a result. So it's important to know what's on that credit report before you start too far into the process.
Right. So when someone gives you or I a call, of course, they do need to be pre-approved, which is the process you're talking about.
Absolutely.
You run their credit score, and then you ask them certain questions.
Absolutely.
Okay, what type of questions do you ask them?
We start with the very basics. Who do you work for? How long have you been there? We have a clear employment history. You've been 2 years on the job. We need a 2-year history of what you've been doing. If you're a student and you work at your first job, that's okay. But we need to have a 2-year history.
Okay.
And then, how much do you earn? We look at it on a monthly basis before taxes. And who do you owe money to? These things are all, of course, corroborated with the credit report. So if you tell me you have a car payment of $200 and the credit report shows $300, there's some disparity we need to get to the bottom of. But generally, I collect, how much do you have in the bank, how much do you earn, and what's your credit look like. Those are the starting points. And then after collecting that information verbally, we collect supporting documentation. Could you please send me your most recent pay stubs or your W-2s? And we'll look at that to make sure that people show on paper what they feel like they earn, because they don't always align, actually.
Well, you know, you and I have done some loans together, but what the information you're collecting, ultimately the underwriting department wants you to validate that as well.
Absolutely.
So what you're being told needs to be validated by documentation, because then someone else is actually giving that approval, correct?
Absolutely.
Okay.
Absolutely. And what we see is people say, oh, I make $50,000 a year. It's because they really make $35,000 with a $15,000 bonus that they've been promised, and I get pay stubs that don't support that. So I need to get that stuff in advance to streamline the process to make sure that what they want to afford or want to buy, we can actually get accomplished these days.
Right. When someone comes to you, and I know mortgage lenders ask lots of questions, but sometimes, and I think how we got into the past foreclosures and short sales, people were overextended.
Yes.
Okay, so I know I like to ask someone, well, what kind of a mortgage payment do you want to have, rather than, oh, you can afford $400,000, because that $400,000 mortgage payment may be higher than what you actually want to spend.
Absolutely.
So.
Yeah, I ask this, we go through the same exercise.
Okay.
And I say, what payment do you feel comfortable with? If they're renting now, then we can, I can make some calculations as to adjust for the tax implications of owning a home, which are really quite significant.
Okay.
If they already own a home, then they probably have at least a baseline understanding of that. But a lot of times, even still, what people can qualify for and what they can pay monthly are not the same answer. I can get them affording much more than they would reasonably spend because they like to go out to dinner,
right,
and they don't want to be house poor. So even still, in the tightened credit markets we live in today, what they can afford on paper and the payment that will allow them to sleep at night are not always the same. So we have to balance those two.
Right, and someone coming in, again, knowledge is power. You got to be comfortable with what you're hearing and what you're seeing.
Absolutely, yeah. It's more than ever we go back to common sense,
right,
and think about what we should doing, not what we can do, but what we should be doing in terms of debt expense.
So if someone comes to you, they give you this information, you run their credit. What's the difference between a pre-approval letter and the other letter? What is the other? Help me out. I'm sorry. Thank you.
Pre-qualifications used to carry some weight. The only time a pre-qualification carries any weight at all now is if the person who issued it knows is a associate. So if I gave you a pre-qualification letter and said, Angel, I looked at this one, it's going to be fine, and you know my reputation that I'm accurate and truthful and candid, that may be okay. But it's opinion, basically. It's an opinion,
okay,
more than a pre-approval, which is, at least for me and my company, means that we have run the loan through Fannie Mae or Freddie Mac's computer system or the government, the FHA system, to get an actual approval, which says that if everything you've put in here and told us is accurate, the loan will be approved. If there's discrepancy, if you put in $100,000 of income and you show $40,000 on paper,
right,
that pre-approval is obviously worthless, which is why we like to collect the stuff in advance to make sure that we can document on paper what you may actually get.
Well, being thorough, I think, is very important, because after they get this pre-approval letter, which actually is a very strong letter that the seller wants to see from a buyer when they find a property, because when they go out looking, they don't want to fall in love with the property and say, oh, I'm sorry, you can't afford that now.
Absolutely. Absolutely. It's time wasted. It's emotional, turmoil to find something you really love and you can't afford it, or you make an offer and you get an emotional attachment to a property, and then turns out that something doesn't align quite right. The bank statements don't look good, or the pay stubs don't look like they should, and you can't get the loan. Everyone spent a lot of time and a lot of effort, and they're upset.
Yeah. Well, buying a home can be a happy time.
Absolutely.
It's stressful, anxious, exciting. It's all those descriptions, but it can be good.